This is the future of what real estate purchases are going to look like. It's going to be very siloed. It's going to be very much, you start with whoever your real estate agent is also going to have some relationship to who your mortgage lender is, going to have some relationship to maybe who your attorney is, who's going to do your title work. It's all going to be very much intertwined. And ideally, in a perfect world, that should be very cost effective for consumers. Episode number 37. Welcome back. This is the Expected Returns Podcast. My name is Stephen Luttman. I'm a real estate investor and agent here in the capital region of New York State. A lot of fun topics for us today. However, before we jump in, just a quick reminder, if you are not currently a subscriber to our newsletter, head on over to sjlincoln.com/join. We usually send out about 2 editions per month, and we do have one going out later this week. So again, head over to sjlincoln.com/join if you do enjoy real estate related content. That is going to be it for the intro. Let's get into the episode. We'll kick things off today talking about the largest story in real estate so far in 2025, and that is last month's announcement that Rocket Mortgage would be taking over real estate broker Redfin, paired with this past week's announcement that they would also be acquiring mortgage servicer Mr.Cooper. Now, longtime listeners of the program might remember episode number 22. We discussed Rocket's program of, if you hire one of our partner agents and then ultimately go through us for your financing, by combining the two, we're going to give you a reduction in your closing costs, ultimately a form of a kickback by combining the two. So this is not Rocket's first attempt into kind of cornering the real estate market, and by no stretch are they the only ones doing it. Zillow, you might remember a few years ago, dipped their toes into house flipping. Ultimately, that program went up in flames. They shuttered it. However, Zillow Mortgage, which you may or may not be familiar with, is actually very profitable. So multiple companies are trying to get into multiple layers within the real estate transaction. This is by far and away the largest attempt to do so. Who are the players involved here? Well, Rocket Mortgage is, depending on the month, either number 1 or number 2 in the entire country in terms of residential mortgage origination. It's them, United Wholesale Mortgage are 1 and 2, and there's a huge gap between 1, 2, and 3. So they are a huge player in terms of people that are purchasing for residential properties, also refinances. They are a massive player. So that's the acquirer. And who are the companies being acquired? Well, we have Redfin, which is going to be bigger in kind of the West Coast and some of the larger metro markets, but they are a real estate brokerage firm, more on the discount side of things. So people would go through them because A, they have a very shiny platform, very user-friendly. Their agents are typically going to be more affordable. I believe they actually mostly work on flat rates. So it's something that's been growing. I looked it up. The closest areas around here is they do have an office based out of Rochester, and they do have one down towards New York City. We don't have any exposure to them here locally, but essentially Redfin, while they do have different services in terms of they do some title work for closings, they do have a very small mortgage lending business as well. However, realistically, what's their value? Well, people go on, and when they're searching for a home, they're either going onto Zillow or they're going onto like Realtor.com or Redfin. So they're great for searching for a property. They are a real estate brokerage, so you're hiring their agents. Mr. Cooper is the very interesting layer to this. So Mr. Cooper is a mortgage servicer. Now, a mortgage servicer is essentially when you have questions about your mortgage. So you need to know how much interest you paid last year and you lost your document, or you need to, hey, I thought I was paying extra towards principal. It looks like it got applied towards late fees, whatever. If you have a question about your mortgage, you call your mortgage servicer, and mortgage servicers get paid by handling those transactions. So whoever owns the mortgage, the holder of the mortgage, has to hire a servicer to handle all the paperwork and things like that. So that's Mr. Cooper. And Mr. Cooper is the largest mortgage servicer in the entire country. So what what Rocket Mortgage is acquiring here is they say, okay, we at Rocket Mortgage are fantastic at mortgages, and we think we've expanded that to a great degree. How do we get even bigger? How do we get into more layers of the funnel? Well, if we get into the real estate brokerage side of things, and then we can also get into the servicing side of things, this acquisition of Mr. Cooper would actually triple the size of Rocket's servicing. So if you look at the real estate transaction as kind of a stool with multiple legs, ideally after these purchases were to go through, each leg of the stool would be able to support the others. So if someone is searching for homes on Redfin and they say, hey, great, we can pair you with an agent, but at the same time, why don't we get you pre-qualified through Rocket Mortgage? Boom. Now we've paired two of the legs together. If you happen to be considering refinancing your home, and typically when we're thinking of, gosh, I need to get some new financing, I want to extend my term, I want to get some money out, who's the first call you're going to make? Well, it's probably overwhelmingly going to be who your existing lender is. So if they can get you on, okay, Rocket is servicing us through Mr.Cooper, a question from Mr. Cooper could then get funneled all the way to a real estate, a mortgage lender at Rocket. So we have different legs of the stool. And then obviously, the fees that are generated by Mr. Cooper for the servicing are also going to be an income stream as well. So ultimately, what Rocket is looking to do here is they want to get their hands in as many layers of a real estate purchase as they possibly can. This is the future of what real estate purchases are going to look like. It's going to be very siloed. It's going to be very much, you start with whoever your real estate agent is also going to have some relationship to who your mortgage lender is, going to have some relationship to maybe who your attorney is, who's going to do your title work. It's all going to be very much intertwined. And ideally, in a perfect world, that should be very cost effective for consumers, because we've talked about before, CAC, right? Customer acquisition cost. If we can get you in one layer or one avenue of the funnel and we can put you through all our different other entities, suddenly our customer acquisition cost is going down, and then we can pass those savings along to our clients. So it makes all the sense in the world. Again, this is the direction that real estate transactions are going to be going. Technology is just way too good and way too easy for it not to be the case. So who's ultimately going to be the winner? Is it going to be Rocket? Well, we don't know. It could be Rocket. It could be Zillow. It could be a startup that we haven't even heard of yet. But ultimately, when you think of what real estate transactions are going to look like 5-10 years in the future, it's very much going to be one large company handling all the bits and pieces of it. From current events, we'll now pivot to something that could be very much in the near future. There is more and more chatter about Freddie Mac and Fannie Mae exiting conservatorship, returning to the private sector, which, if it were to happen, would represent the largest event in real estate since the Great Recession. That is not hyperbole. It cannot be overstated how important these two businesses are in real estate. The inner plumbing of the mortgage market very much depends on Freddie Mac and Fannie Mae coming in, buying loans from banks, from credit unions, reinfusing them with cash. Then Freddie Mac and Fannie Mae package up these loans, sell them off as MBS. Mortgage lenders being given additional cash to go out and do what they need to do is what allows you and I to be homeowners. Otherwise, if lenders can't lend, we are all suddenly going to be renters, right? So it's incredibly important that there's someone there to take the loans off the books, give them cash, continually cycle through it. The backstory here for some context is 2008, 2009 housing crisis. The businesses were just getting slammed. And what the US government did was they came in, gave a large infusion of cash, almost $200 billion. And in exchange for that, the government got essentially preferred stock. So they took ownership of these two businesses, put them into conservatorship. They were identified as very, very important for the systematic function of the real estate market. If these two businesses were to fail, they could potentially take the whole economy with them. The government said, no, we can't have that. Here's cash. Keep doing what you're doing. We're going to take ownership, which ultimately, fast forward to 2025, has been a home run because the U.S. government has more than doubled their money on the investment, and we're continually being paid back. They send funds, I believe it's monthly, potentially quarterly, but it goes to the U.S. Treasury. So we are continually making money on this purchase, the stock deal going back to 2008. So it's been a great purchase. The question then becomes, well, why sell? If it's going so well, why would the US government ever want to give up on something like this? First and foremost, it was not intended to be a permanent thing. This was very much we're in the midst of a financial crisis. We need to kind of stop the tidal wave of businesses going under. This was identified as a very important cog in the economic system. Let's support them and eventually push them back out into the private sector. So the argument can be made that if you had asked people back in 2008, 2009, how long would it be until we got this off our books? It probably would have been 5 years maybe. So the fact that it's 2025, the U.S. government owns such a large portion of Freddie Mac and Fannie Mae is not usually what most people would have said was the initial intent with the deal. The other aspect of it is very risky. So if suddenly there was an economic downturn and a bunch of people were to default and suddenly mortgage businesses dry up, this purchase could go south very quickly. So it's a large amount of money. So it's a large amount of money on the books of the American taxpayer. So it's going well now where the Treasury is raking in monthly fees. However, that doesn't necessarily mean that's always the case. So it wasn't meant to be permanent. It's very risky to put on the backs of the American consumer. And finally, it's worth a whole bunch of money. So the expectation right now is if this were to sell on the market, the value would be somewhere between $250 to $500 billion. And if we're in an environment of we're looking to reduce government spending, we're looking to increase government revenues, well, this would be a great avenue to do it, because if we could sell this off for $250 million, that's a large amount we could put towards the national debt or however else the current administration wants to allocate such funds. So there's a lot of arguments to be made that now would be a great time to kind of offload this. The question then becomes, who's going to be the buyer? And at that dollar amount, it can't be one entity. If we look at kind of the largest companies on planet Earth, let's say it were to sell on kind of the upper end, so it's worth $500 billion. Well, that would make the combination of Freddie Mac and Fannie Mae somewhere in the top 20 of all companies on planet Earth in terms of market cap. So it wouldn't be able to be, just one business that were to come in and be able to acquire it. It would be, probably a consortium of, JP Morgans and Blackstones and things like that. So it would be rather difficult to find a buyer. However, that's not to say that it can't be. How does this impact us? Because every story we tackle, we always want to view it from, we want to be informed, but ultimately we want to get smarter, but also we want to make money. So how does this impact us as American consumers? In my opinion, and this is just my opinion because we've never seen this play out before, in the short term, if this were to be sold off, I would expect mortgages to become more expensive in the short term. Long term, probably less expensive. And the thought process behind that is our mortgages are pretty reasonable today because of the backstop of the American government. So right now, if you own MBS on residential mortgages backed by Freddie Mac and Fannie Mae, if Joe Smith, if you own a package of 1,000 mortgages and Joe Smith is in there and he defaults on his mortgage, the government is guaranteeing that dollar amount. So they will step in, and whatever the end financial loss is on that particular mortgage, they will make the holder of the MBS whole. Okay. The moment you send Freddie Mac and Fannie Mae back out into the private sector and you start to shrink that government guarantee, or especially if you were to eliminate the government guarantee, okay, suddenly that MBS becomes a little bit more risky, right? The government backstop is gone. There's more risk. And if you're asking an investor to take on more risk, what do they want? They want more return. And in exchange for more return, that's going to be, from a consumer standpoint, we are going to be paying more for our mortgages because we now need to compensate the investors. Ultimately, my best guess would be it's going to take some time for this to play out, but the private sector is great at solving problems like this. And ultimately, there would be ideally multiple companies formed to go after privatizing and securitizing mortgages. So multiple companies would be competing to do what basically Freddie Mac and Fannie Mae does right now, guaranteeing loans. And ultimately, ideally, in a perfect world, this competition would then lower prices. So again, my opinion, this is my best guess, but in the short term, after these were to be set sail, adios, government is saying goodbye, I would expect mortgages to be more expensive. However, fast forward 5-10 years, I think the private sector will figure this out and it should be able to drive down prices. So ultimately how this is going to play out, who's to know? We haven't really seen something like this happen. And, especially in my lifetime, I'm not familiar with anything like this where such a large part of the government was kind of severed off and sent off into the private sector. But ultimately, that would be my best guess. But it would be a big deal. So this is something worth keeping your eyes on. whether or not Freddie Mac and Fannie Mae are going to stay within the government regulators and under government control, or if there's a sale to be made, and realistically, how much would we be able to repay the American taxpayer? Is it going to be something like $250 to $500 billion, which in that case, maybe now's a good time to make that sale happen. All right, 3 stories rapid fire before we get out of here. The first one, blacklisting of condos. Now, this is pretty interesting because we've seen whether it's disasters down south, wildfires out west, insurance premiums are going up, up, and up. And this is kind of the second layer effect. So what happens after insurance premiums go up? If you live in a condo, oftentimes you don't have a homeowner's insurance policy similar to what you would have if you had just kind of your standalone single family house. Oftentimes you're paying into an HOA. What the association does is they take everyone's money and they go out and they purchase a blanket policy that covers the entire building, right? Well, what's happening is because these premiums are going up, up, and up, and these people that live in the condos sometimes can't afford their premiums going up 150%, 200%. The associations are now faced with, well, how do we cut back? And what they're doing is they're purchasing maybe the same dollar amount of insurance, but the insurance might not cover everything that it did 2 or 3 years ago. Or they're cutting back on, maybe they're not investing back into the properties as they should. So what's ending up happening is Fannie Mae, as we talked about in our previous topic, they're saying, well, we don't view your insurance premium as sufficient to cover, God forbid there be some kind of a disaster. So we are not going to lend on your specific property, your 200 condo building or 50 unit condo building in Miami or wherever it might be. So now what's happening is sellers of these condos are running into a situation where they're a week away or 2 weeks away from closing on a sale, and the purchaser's lender is coming back and saying, no bueno, we're not going to close because your property ended up on this blacklist. So apparently there is actually a list held by Fannie Mae. It's not public, but there was this one firm that actually came across it and publicized it for everybody. You can't go onto Fannie Mae's website and see it, but it is, if you Google it, it is out there. And there are thousands of properties throughout the country that you cannot get a Fannie Mae loan because for whatever reason, they didn't view the association as having enough insurance to cover the building. So if you live in this building, what do you think this is going to do to your property values? And this is kind of a vicious cycle. If you can only sell your property to cash buyers or to people that maybe find outside types of investing or outside type of mortgage, what do you think this does to your property values? Well, when your buyer pool shrinks, your property value is also going to go down. And that's not just for yours, but that's for all of your neighbors, everybody that lives in the building. Now their property is worth less and less. So this is very destructive. But again, when we see what are the impacts of natural disasters, is it just for the people that live in that community? No, this is a nationwide issue that we're running into. So blacklisting of condo projects, yeah, it's something like 5,000 properties now. But what is it going to be if natural disasters continue on the trajectory? How many more projects are going to be involved in something like this? Next one is the Trump administration is talking about selling federal land for property development. So as we've talked about in previous episodes, we simply do not have enough homes in the country to satisfy the demand. And part of the issue is that not only is construction costs going up, but land is also at a premium too. So believe it or not, the federal government actually owns about 25% of the entire country of acreage. So the federal government owns quite a bit of land, whether it's national parks or just wetlands or places that have been set aside for various purposes. And the proposal is, well, let's see if we can maximize some of this acreage, put it to use, start building some homes. This is going to be a small sliver in the overall how do we solve the housing crisis. Yes, we do need more land to build properties, and if the government is willing to sell that off to developers to help do that, that will alleviate some of the problems. Obviously, we need to talk about reducing kind of some of the red tape that prevents building. What this is not going to solve, however, is we do not have enough people capable and talented enough to build enough housing, and we also don't have enough people that can currently afford to purchase at the current rate that it would take because construction costs new construction, 5 years ago might have been, call it $200 a square foot. Now you're paying something like $300 a square foot. So we need to get prices down. Will selling off some of the acreage that the federal government owns help the housing crisis? I think it's an interesting idea. My concern would be we have a lot of layers of bureaucracy involved in this. So it's the federal government, obviously, because they own the land. Then they're going to involve the states because they're going to reach out to the states and say, hey, what's your opinion? Where should we be going after? Where do you guys have a need for housing? And then certainly the local municipalities are going to have, voicing their opinions too. So there are going to be a lot of layers in this, in addition to involving the private sector, who's ultimately going to be doing the building. But I think it's a step in the right direction, but there's not going to be one fix to the housing situation that we're in. There's not one single thing we can do. So I think this is a good step, but even if you were to sell, 50%, they're not going to sell 50%, but even if they were to sell, half of all the land, we still need people to build it. So again, I think it's positive, but we'll see how it shakes out. Last, if you're a home seller, one of the things you want to maximize is the number of eyeballs on your property. However, your agent might not necessarily agree with that. So there's an interesting piece going around about there's certain large real estate brokerages that want to be able to limit the amount of exposure that their listings get. So essentially what they're saying is when we as agents take on a listing, we put it on the MLS, it gets maximum eyeballs, it gets pulled in by your Zillows, your realtors.com, your Redfins, everything like that. There are certain brokerages out there that say, well, let's pump the brakes. We don't necessarily, in our opinion, some of our clients don't want all of that exposure. We would rather keep it in-house, keep it low-key, shop it around to the different agents in our office, because we might have agents, we might have home sellers that prefer to do it that way. Can you see why this would be a little bit counterproductive if you're a home seller? Now, if you're the brokerage, this makes all the sense in the world because you would love to two-side the deal, right? You would love to be able to represent the seller and then bring that seller a buyer and represent both sides of the deal. Now, the opposition to that would be, well, if you're really acting in your client's best interest, you want to be able to get them top dollar. And if you're only keeping it in-house, that's not necessarily acting in your client's best interest. Now, what would be an exception to this? If you're repping someone that's, let's say, a celebrity of some sorts, they probably don't want their house on, Zillow and the MLS. So I think there's an argument to be made that in certain very rare circumstances, something like this would make sense. However, for 99% of the people in the world, don't take this advice. You want to be everywhere and as often as you possibly can. So whether it's social media marketing or radio ads or hey, come take a look at 123 Main Street, whatever it is, that's what you want. So don't let an agent talk you into, hey, let's keep it off the MLS for a week or two. Let me find you a buyer because, are they acting in your best interest? It's possible. Again, I'm sure there are other circumstances out there where that would make sense. But again, if I'm selling, whether it's a house or a car or a collection of basketball cards, I don't want to limit the number of people that can see it. I want maximum exposure and get as many people bidding on it as possible. So that's going to wrap it up for today. Hopefully you got something out of this. If you do want to connect with me, Steven@sjlincoln.com. That is my email address. If you'd like to schedule a call or a Zoom video with myself, it is sjlincoln.com/book-a-call. And I'd be happy to chat with you. I think next episode, we're going to focus on user questions. So if you want to do me a solid, get me questions, whether it's real estate, finance, whatever you guys want to talk about. But I'd really love to kind of get back to answering whatever's on top of mind for you guys. So Instagram, sjlincolnrealty, Facebook, Twitter, obviously YouTube, sjlincoln.com/join. That's for the newsletter. And again, to get me, Steven@sjlincoln.com, sjlincoln.com/book-a-call. Thanks for watching, and we'll talk again soon.